I looked at 50 real rental properties in just 30 days. And what I found might shock you. Out of all 50, only 3 would actually make money in year 1. That's not a mistake. That's the harsh reality of investing in 2025. And in this video, I'm going to show you why. We'll break down the numbers, walk through the exact system I used to evaluate these deals, and most importantly, we'll reveal the 5 financial metrics that separate winning investments from money pits. By the end, you'll know how to analyze any rental property in under 10 minutes with a system backed by real-world data. And yes, I've got a downloadable analysis calculator waiting for you, too. Let's dive in. Everyone talks about cash flow, but very few actually understand what it takes to generate it. Of the 50 properties I analyzed, 24 would have negative cash flow, meaning you lose money each month. 18 would barely break even before repairs, vacancies, or management, and only 8 showed any promise at all. After taxes, reserves, and actual debt costs, only 3 were solid performers. So what made the difference? Let me show you. Example 1. A working-class duplex. Purchase price, $400,000. Projected rent, $3,600 per month total. Expenses, including mortgage, taxes, insurance, maintenance, and management, came out to $2,900 a month. Cap rate, 7.3%. Cash-on-cash return, roughly 8%. This one works. It's in a C-plus neighborhood, but tenants stay long-term. Cash flows around $700 a month, even after accounting for vacancy and maintenance. More importantly, it passes what I call the interest rate test. If your cap rate is lower than your interest rate, you're in negative leverage. Right now, the 28-day T-bill pays 4.05%. That's risk-free. You can park cash there and do nothing. So ask yourself, why would I buy a property earning a 4% cap rate when I can earn more on a Treasury bill with 0 work and 0 risk? You wouldn't. Cap rates must exceed your borrowing cost and clear the risk-free rate by at least 1.5% to 2%, or you're simply not being paid to take risk. Let's look at example 2, College Town single family. Purchase price, $350,000. Rent, $2,600 per month. Cap rate, 6.2%. Debt rate, 7.25%. Cash-on-cash return, about 4% after a full 20% down. This deal barely breaks even. And you're using your own cash to cover the gaps. The debt costs more than the return. In private equity, this is unacceptable. If the return on investment is below the cost of capital, the deal gets thrown out. Same logic applies here. Example 3, a value-add triplex. Purchase price, $450,000. Current rent, $3,200. Post-renovation rent of $4,500. Cap rate today, 5.2%. Some cap rate stabilized, 6.8%. Cost of renovations, $40,000. This one works, but only if you execute flawlessly. You're creating value by raising rents and upgrading the units. The equity growth comes from forced appreciation. But even then, the stabilized cap rate is just barely higher than your debt cost. You must buy it well below market, renovate efficiently, and manage tightly to justify this deal. Now let's talk about the 5 metrics that separate winners from losers. Number 1, cap rate, your unlevered return. It must be higher than your debt rate plus at least 1.5%. Number 2, cash-on-cash return, your net cash flow divided by your cash invested. If it's under 6%, it's probably not worth the headache. Number 3, debt coverage ratio, your net operating income divided by debt service. If it's below 1.25 times, you're in the danger zone. Number 4, appreciation potential. Strong markets with upward trends help, but never rely solely on this. Number 5, exit strategy. If you had to sell in 3 years, can you break even? Or are you stuck with a dud? Here's exactly how I broke down all 50 properties. First, plug in the purchase price, down payment, and loan terms. Estimate rents based on comps and actual leases. Factor in all expenses: insurance, taxes, property management, repairs, reserves. Calculate your net operating income. Then use that to get your cap rate, DCR, and cash-on-cash return. The spreadsheet does the rest. You don't need to guess. The numbers tell the truth if you ask the right questions. And here's why the cap rate versus T-bill test matters more than ever. With Treasuries yielding 4.05%, you have options. If a rental property doesn't outperform that benchmark, it's not worth the risk. Real estate comes with liquidity risk, tenant risk, repair risk, tax risk, and market downturn risk. So you better get paid more for holding that asset. In 2020, a 5% cap rate worked when interest rates were 3%. In 2025, that same deal loses money because debt is more expensive and T-bills outperform it risk-free. This is what smart investors call relative return thinking. Not just how much will I make, but how does this compare to my other options? So here's how to know if a property is worth pursuing. Cap rate greater than or equal to your interest rate plus 1.5%. Debt coverage ratio at or above 1.25 times. Cash on cash return at or above 8%. Strong rent comps and population trends. Clear path to value creation, either now or later. If it misses 2 or more of these metrics, pass. There are too many ways to lose money in real estate. Don't add bad math to the list. Want to analyze deals like this yourself? Download my free spreadsheet, the same one I used to analyze all 50 properties. It includes cap rate calculations, DCR logic, tax estimates, and side-by-side ROI projections. You'll find the link in the description. Start using the system. Run real numbers. Compare each deal to the 4.05% T-bill. Ask yourself, am I getting paid for the risk I'm taking? Because that's the core of every great investor's mindset. If you want more deal breakdowns like this, subscribe to the channel and drop a comment below. What's the hardest part of analyzing deals for you? Let's break it down together.